Hey everyone, this is Kirk here again at Option Alpha. So I want to get into this one today, which is 5 things you need to know before you start live trading, helping you set realistic expectations for real money options trading. I hope you enjoy this one because we get a lot of questions about this. We see this a lot in the community, and people have asked for kind of like a getting started guide, help you get some confidence before you make your first trade. So I put these together with the team so that we can give you our best advice, our best suggestions, our best practices for how you can set yourself up for success before you start live trading. So let's jump into it. First thing you have to know is that live markets are not the same as paper trading markets. I know that seems like a really easy thing, but a lot of people actually don't realize that live markets are truly different than paper trading markets. In paper trading and any simulated trading or, paper trading environment, you just are doing your best guess as to when a trade could fill. And you could add a lot of conditions and a lot of different things. But even if you do that, even the best platforms, even everything we can try to do here at Option Alpha, it's just never going to be exactly the same as a live environment. So live is always going to be different. And even more so than that, the options market itself is different. It's different than the equities market or futures or Forex. Got a lot more moving parts with the different strikes and expirations. So it makes it a little bit tougher generally to fill. And so you got to be watching out for some of these things. Again, we'll go through these here together. So again, it's completely missed by a lot of traders, but there are some differences, of course, between simulated and paper. The first thing that you have to go through or you have to understand is that liquidity matters. And those tickers that have the highest liquidity ranking in the screener will track much closer when you actually transition them to from paper trading to live trading. So what do I mean by this? Well, if you go into the screener in Option Alpha, we have a liquidity ranking tool, and this is based on live trades only, that helps you rank the liquidity of all the different symbols inside of Option Alpha. So if you just go here and you say, okay, I want, liquidity ranking of 4 or higher, this will get you all the symbols that have great liquidity based on our ranking for those symbols and live trades actually placed through Option Alpha. So if you even filter this list even more, you could say, okay, just ETFs and liquidity of 5 or higher. Then of course you get a really, really narrow list of symbols that have the best liquidity. If we do the best of the best, there's only a handful, of course, that are kind of top liquidity. Again, it's all based on live trades. But if you look at SPX here, you can just hover over the liquidity and you see actually the liquidity stats. You see it's the number 1 ranked ticker, which maybe is no surprise because SPX is super, super liquid. And you can see that the fill price here is about 55% of the bid-ask spread. So that's that fill price that you see right there on the bottom left. And so that helps you understand, okay, if I place an order, where is that order likely to get filled? And in this case for SPX, because it's the most liquid thing, it's likely to get filled pretty much near mid price. And you can't say this for all symbols. So when you do your paper trading and when you do your back testing, if you're testing in paper trading SPX, when you transition to live, it's much more likely that you're going to have results that are similar because you're testing something that is fairly liquid to begin with. So it doesn't require a lot of massaging and a lot of different conditions and indicators and things like that to transition it. Now, if you do something different, like let's say we say, well, we can stick with ETFs. Let's say we go down in ETFs to something that has super, super low liquidity. We can even take off ETFs and just go with things generally that have lower liquidity. Okay, well, you can see here, this is AAP, which is Advanced Auto Parts. I'm just picking one out. Ranking is 212. The slippage on average is about 6 cents. The fill price between the bid-ask spread is about 61.8%. So that means that you're pretty much never going to get filled at or near mid-price. You're going to have to go from mid-price to get filled. Now, the problem is that sometimes people will test a paper trading strategy, for example, on AAP. They'll assume that they get filled at mid-price, or they'll place orders in mid-price, or have their smart pricing stop in mid-price and maybe fill, but you just don't know if that's going to fill. And we don't even know if it's going to fill all the time at 61%. Sometimes it may feel a little bit higher, sometimes it may feel a little bit lower, but generally if you're testing AAP and then you start transitioning it to live, you're going to see a little bit more of a disparity between those. So some of these ones here can get pretty wide. So if you go down and let's just sort by least liquidity, BND, which is Beyond Meat here, ranking 218. You can see fill price 72%. You're almost going 3/4 of the way through the bid-ask spread. So again, it's really important that you kind of take note of that as you're moving forward. You just find those ticker symbols that have high liquidity. And then what you can do is you can create a new watch list from these symbols right inside of Option Alpha and then just use those symbols. So that's the first thing you can do. Make sure you definitely trade highly liquid symbols. The other thing that we want to talk about is, of course, illiquid tickers, obviously, or we talked about that. But remember, someone has to take the other side of your trade. This is just like a big, broad point, but it's something that we have to get across because it's so important, is that you have to remember in the options market specifically, someone else is taking the other side of your trade. So if you're placing a trade, you got to think some other participant or market maker or somebody is taking the other side of that trade and holding the other side of that trade. The logical question would be, do they want to take that position? It doesn't make logical sense that they would want to unwind that position. Now, in a paper trading environment, you could simulate anything that you want. You could simulate a close around 355, or you could simulate an entry. But when you start adding just a little bit of logic to it, a lot of it breaks down very quickly, especially at the extremes. And this is where we see people have issues, which just have unrealistic expectations at the extremes, and they don't add any sort of like logic or rational thinking. So here's an example of this so I can show you. So this is a QQQ Iron Condor backtest. This one came out of the top backtest in the community only because it had crazy profit, total profit. However, when you look into this strategy, and this is what we always encourage you to do, is kind of validate results, see things. We give you the ability to test everything you want, but you got to kind of go through this yourself and kind of validate it. But if you see here, what they're doing here is they're testing up to $100,000 allocation and position sizes of $20,000 at a time. So again, I don't know if a lot of people would do this. I certainly wouldn't do this. That's 20% of your portfolio basically on one position every single time. Like immediately to start, you're betting 20% of your portfolio right out of the gate. That just seems unrealistic on its face. Okay, but even if we kind of cross that barrier and some people say, yeah, sure, I would definitely do that. Then you go down here and you look at this and you see that the entry time was 3:55. So they're entering a new position at 3:55, literally 5 minutes before the market closes. And that just doesn't seem realistic for selling premium, because if you go into the actual positions and you just take a look at the very first one here, this would mean that you could sell 253 iron condors in QQQ. That's not 253 individual legs. That's a four-legged position, 253 contracts, and you would sell that for an average price somewhere around $20. Now, no other market maker is going to take the opposite side of that trade 5 minutes before the market closes. Just highly unrealistic that somebody is going to be willing to pay $20 for all these contracts that you're, as a group, like each one for $20, 253 sets of iron condors 5 minutes before the market close. It's just not realistic that that would actually happen. Now, can you test it? Of course you can test it, but you got to set some logic barriers in place. So this leads us to number 2, which is that orders do not equal fills. This is a really big one. So this is kind of the same thing as, live markets and paper markets are different, but it's one step further, which is that a request for a trade does not mean it will fill. This is a really big important point, is that if you request a trade to fill, that doesn't mean somebody on the other side is going to say, well, thank you, because you just requested this, I'm going to fill the position. The analogy I always use is, because my kids ask for ice cream, that doesn't mean that they always get ice cream, right? So they can ask and ask and ask and ask, but that doesn't mean every time they ask, I'm obligated, I'm guaranteed that I will give them ice cream. In fact, I don't all the time. So first thing is you got to set realistic pricing, or even pessimistic pricing when backtesting or paper trading. I'm a big fan of this always, which is that A, set realistic pricing if you're testing, right? And we know we have to use liquid tickers anyway, but even beyond this, try to use pessimistic pricing in your backtesting and paper trading. Try to use kind of the worst case scenarios to a certain degree, because if it still works, then it gives you a margin of error that when you transition to live, you have that kind of cushion to move up with, right? As you attempt to mimic those live trades. So one thing that you can do, and this is an example again, using backtesting, but if we just use backtesting right here inside of OA, the first strategy here, this strategy number A, is this one here. This is just a baseline iron condor entry, 945. The strikes don't matter for this example, but we were targeting $50 profit. So whenever we got to a $50 profit, we would close, no slippage. So what I did here inside this strategy is I did not have any slippage. There's no slippage included in this strategy. So the assumption is as soon as you hit $50, you're done. You're in and you got your $50 profit. And forever, we would always get exactly $50 whenever the market hit exactly $50 of profit. Now, could you test that? Of course, you can test that here and you can see it does fairly well. But if we introduce just even the smallest amount of slippage, so just kind of going in here and looking at this position in the back testing, if we said, hey, look, let's say we have $5 of slippage on trade entry, okay? So let's say we don't get in for the price that we want. Maybe it was targeting $155 as an entry price, and we got in for $150, right? So that seems pretty realistic that you have a little wiggle room to get into the position around 945. So let's introduce a little bit of slippage. The other thing I did is I said, look, I want to require that your profit target gets hit at least 2 consecutive times. So it's not some random backtesting print of a mid price around $50. No, this was consistently hit as like the mid price minute after minute was around that $50 mark. It's much more likely that a real order, a live market order will fill if you are consistently hitting that mid price in your back testing. And then the last thing I did is I said, look, let's still include 5 cents of slippage on the exit. So assume that even though we're going to try for this price, we may actually get filled for this price. So it's even more pessimistic. It's even more aggressive. It needs to collect even more premium. And once you actually do that, then you start to see how much of a difference slippage can make. And this is really, even for something as liquid as SPY, if you're not including slippage, you're not testing realistic expectations, that's a big difference. And that can be, in this case, it's a very big difference. Some strategies, the difference is very, very small or not that different at all. Those are the ones you want to focus on. So if you're not doing this as part of backtesting, make sure you start doing this. By the way, I'll include links to all of these things, all of these resources right below this video so you can go in here and test your own versions of it, take a look at it, start playing around with it, moving forward. Makes it really, really easy. Again, the number two thing in here, but down below, I definitely suggest using both bid-ask spread guards. This is ways that you can kind of help protect yourself from just placing random orders, but then also placing orders that are more likely to get filled. Definitely suggest using bid-ask spread guards, smart pricing controls for slippage from the mid, and then again, be cognizant of PDT rules for smaller accounts. So if you are starting to transition to live trading, make sure you're cognizant of PDT rules. It's an easy checkbox inside of smart pricing to prevent a bot from entering or closing a position that would flag you as a pattern day trader. So let me show you how I use them and how they work. So inside of any bot that you're running, this is a live bot that I'm running right now, you'll have the ability, of course, to set your exit options, which are attached to every position, just manages that position using exit options. And so inside of any exit option position, you can see this is a position that's live right now. And you can see if I go here to the exit options section, I have my profit taking and I have my bid-ask spread guard. Now this bid-ask spread guard is in place. It's to protect me in case the bid-ask spread starts to go really wide. And what will happen is that if the spread goes really wide, which means that for whatever reason right now the liquidity in that contract or that set of contracts is not great, then it will protect and make sure that I don't start placing orders with a really wide spread. So that helps make sure that we don't get trades that are filled in really wide markets. Now, currently for this one, the bid-ask spread is about 14 cents. This will keep updating throughout the day, but you can see my guard is set a little bit higher. It's about 40 cents. Some are a little bit higher, some are a little bit lower. In this case, if I go to something else like this one, I don't know if this one will be, this one actually got filled as we were just talking. But if I go to something else, yeah, here's a good example. Sometimes it will go really, really wide. So in this case, right now, the bid-ask spread is 154 and my guard is set at 40. So even if the mid price of this wide spread is showing a profit or whatever, the market's just too wide. That's unrealistic pricing. And so having those guards in place, even for paper trading, can help improve the results of your paper trading, which will improve as you start transitioning to live, because it's not going to place orders in a super, super wide market because it's just very, very unlikely to fill. Now, even more so than this, what you can also do inside of your exit options is you can use something called slippage from the mid. Notice I do it here inside of my expiration exit option for these types of positions, I tell the bot, hey, look, if we get to 30% profit, take it. But if we get to 1 day before expiration, we're going to start closing the position and use 3 cents of slippage from the mid. So what you can do here is you can actually set your final price in smart pricing. A lot of people don't use these advanced controls because they're so powerful. They're so easy to use. You just try to choose the one that you want to use. You can say 100% of the bid-ask spread. That's what a lot of people leave the default to. That's not wrong necessarily, but it does allow the bot to go all the way through the bid-ask spread. So if you have a dollar wide bid-ask spread, you're going to be losing $100 on a potential trade, right? So what I do is I say, look, I will allow the bot to go 3 cents of slippage from the mid. So even if the spread is really wide, that controls my pricing. So I'm only going a little bit from the mid to make sure that I get it. Or you could also use 100% of typical slippage from the mid for this symbol. And that will, again, use that slippage amount that is found in the ranking. So for different symbols that you're trading or different tickers, you can allow it to kind of self-correct and self-adjust as it goes. For some symbols that are a little bit bigger, you can have tighter slippage or wider slippage. So that's another one you can use. Again, it's a multi-step final price, so it uses kind of the best pricing option for you. So what I typically do is I do for many of these, I do slippage from the mid. That just means I can control it myself, and I know exactly how far I want it to go in pricing. So here's a couple examples of it. So this is a different position that closed, again, live position that closed. But this is also showing you that sometimes when you place an order, it doesn't mean you're going to get a fill, but that also doesn't mean that you can't later get a fill and maybe later get a fill at a better price. Oftentimes we see people say things like, well, I had an opportunity to fill a trade and it never filled, so I'll never see that price again, and I never had this opportunity. This profit is gone and it's never coming back. Not true. Here's an example of it. There's many examples that I could probably show you. So in this case, this position here was entered in October of last year. It filled for $2.29. That was our entry, and I had a 30% profit taking level. Now you can see on the 23rd, October 23rd in the afternoon, it was showing that we could take a profit, and smart pricing started entering orders, but we did not fill those orders. So if I click here, you can see that the bid-ask spread was fairly narrow. That's great. And you could see that I tried the price here of 160. It was probably estimating that the real exit price would have been about 163. So no big deal, because I was still trying to get my 30% profit on this one. So that canceled and it stopped. Now, a couple days later on the 30th at 3:58 in the afternoon, so basically right at the end of the day, again, it showed that I could have potentially gotten into a fill. It was kind of quoting something around 160 that was potentially going to be able to fill. So we tried an order. It didn't actually fill. It was looking like 163 was going to be the final price. But again, I was trying for that 30% profit. Then later on the 31st at 9:40 in the morning, I actually got filled for a significantly better price because I was 160 was kind of my higher upper bound. But notice that the market opened, the bid-ask spread, although it was a little wider, was still showing that I could get out of the position for a bigger profit. And so it started to attempt trades, and it could have attempted more trades inside of that bid-ask spread that I was allowing it to go through, but it did actually fill at 146, which is great, which means that even though I was trying to get a profit and close the position for 160, which would have been great, I actually closed the position for 146, which means I got even more than my 30% profit. This again just shows you, just because you place an order, A, doesn't mean it's going to fill, but B, it doesn't mean that it won't eventually fill. Markets are moving, they're fluid, and so you have to continue to attempt those prices when the prices make sense to get into them. Here's another example. This one's a little bit more long-term, but again, same general concept, different ticker symbol. But you can see all the orders that it tried. So I originally got in this position. This was just a couple months ago, or about a month ago. You can see June 25th is when or June 24th, 2025, filled the trade at 120, still shooting for that 30% profit on this one. And you can see how many different days and times it started to try to get into this position. Ultimately, it was able to fill the trade here. And this was on the 14th after it had tried for a number of days to get into it. That's fine. That's okay. Notice that what I did here is I only allowed it to start moving enough to get the fill. So even though the bid-ask spread was wide, Smart pricing was protecting me by ensuring that I got my profit taking level out. So again, these are kind of examples here. There's many examples of this, but make sure that you're using bid-ask spread guards. Make sure that you're using slippage from the mid. And again, just be patient with your trades as they start going in. So remember, unfilled orders doesn't mean something's wrong. It's just purely a function of the market and real world liquidity. So let the bot do what it's going to do. Continue to place those orders. If the market's there and if pricing's there, it's going to get out of the position. You'll fill the trade. Number 3, management for in the money positions. So as you start transitioning to live trading, you definitely want to avoid surprises by doing this now. We do see this often with people who start transitioning to live. They just forget or completely miss the fact that in a live market, actual positions will be assigned if they're in the money at expiration or near expiration. So remember, an option contract that's in the money can be assigned randomly. Now you can't model this out. We can't make any assumptions in paper trading about what's going to be assigned or not because we just don't know, and it's very few number of trades that are actually assigned. But it isn't bad necessarily that this happens because it's a function of the market, but you should plan ahead for this. So we definitely suggest that you use a combination of exit options and monitor automations to kind of manage positions that are in the money. Because again, proactive management here is not going to ever guarantee that you won't be assigned, but it's not going to be as much of a surprise or a shock. So here's a quick solution for you guys that will help out. So one of the things that you can do, and again, I'll add links to this inside of right below this video so you can check this out. But one of the things that I add to my bots is this monitor automation that I built and shared in the community, and it's called Early Assignment Risk Management. It's called a bolt-on because essentially you can add this to any bot that you're running right now. And if you're selling premium like I am, where you're doing credit spreads and iron condors or iron butterflies, you just simply add this automation to that existing bot, and then it manages the assignment risk for you. So in this case, what it's doing, just so you know, is it's going through every position in that bot, seeing if the bot has a position that expires soon. This is your threshold, whatever soon means to you, 5 days, 6 days, 7 days, whatever it is. It determines what type of position it is. So is it a short put spread? Is it a short call spread? Is it an iron condor? And then what it does is it does a series of decisions to check and see if there's a higher chance that that position is going to be likely to be assigned. And if it is high likelihood of being assigned, the answer to that question is yes. Then what it does is it closes that position. Again, notice I use 3 cents of slippage from the mid, even though there might be a high chance of assignment on that position. That's not a 100% chance of assignment. I don't need to force close the position and get a terrible price. So just try to close the position, work around the mid price, start moving from the mid price and close it. And then I also tag the position as early assignment risk. That way I know why the position was closed in the first place. So again, you can add this automation directly to any bot that you're running right now. I shared this automation in the community, so I'll link to this post. It's got a video kind of explaining how option assignment works. Again, it's nothing to be afraid of. You're gonna have it if you are trading long-term in options. You're gonna be assigned positions, totally manageable if you keep your head cool and just work through it. So there's a video kind of explaining that. And then also what you can do is you can simply save this automation to your library directly. So if you're watching this right now, you can just bolt this on to your bots. Now, the other thing is actually while we were actually doing this video, I noticed that this actual position did close a position in my EEM bot that I just started for this Iron Condor portfolio, and notice that it tagged it early assignment risk. So if I go here, I can see that this closed literally this morning, filled the trade to close the contract, and that was due to the automation running. So the automation log was running to check for early assignment risk. Does the position expire soon? Yes. Is it a put spread? No. Is it an iron condor? Yes. Is it at risk of early assignment? Yes. The short call underlying price was above the short call leg. My chance of being in the money was 89% at expiration, and there's very low extrinsic value on that leg. Therefore, I know that that leg has a higher chance of being assigned, so I'm going to go ahead and close the position. So this is what that does. Again, it's really helpful to kind of pre-manage this process for you. Number 4, Option Alpha and Broker Sync, keeping everyone in harmony. It probably goes as no surprise, but it's worth repeating again. All of your trading done inside of Option Alpha is reflected in your brokerage account. So all your orders, all your fills, all your positions, anything you do in Option Alpha gets reflected inside of your brokerage account. However, there are actions and events that happen outside of option alpha that are not pushed back to option alpha. We don't know about them. By the way, we wish we did. We wish brokers would push those events back to us and tell us that those events happened, but they don't. And so you'll want to make sure that you update your positions to reflect any changes. This specifically occurs with assignments and exercises or manual trades that are done inside your brokerage account. Not manual trades done inside of option alpha, manual trades done inside your brokerage account. We just don't know that those things happen because they happen outside of option alpha. So you want to make sure you sync up everything inside of option alpha. So one thing that we do all offer, by the way, is inside of a position. If you ever did want to close a position or remove a position, of course, you can manually close a position directly from option alpha. You can do everything you need directly from option alpha by just going to the position, closing the position here. You can even add new positions and just manually trade, as many of you know. Now, although we don't know that some of these things happen outside of option alpha, we can detect a missing position. And so one of the things we released in one of our recent updates was the ability to auto detect missing or assigned positions and get a notification. So inside of your account and inside of your emails, if we find, as we're kind of going through and trying to sync your positions, if we find that there's a position where we do not find a leg of a position, then we will detect that and send you a notification. And this is kind of an early warning signal that either A, you close the position maybe yourself and you know that, or likely the position was assigned and has been converted from an option contract to an underlying equity position. So that's most likely the case that happens. But again, you'll see this right inside of your dashboard. You'll also get a notification about it. So just be on the lookout for that. Again, we don't know exactly what happened. Maybe you did mean to close the position. You wanted to close it and you just forgot to close it inside of option alpha. But as you're starting to live trade, again, make sure that you do everything you can inside of option alpha. That way everything continues to be synced up. If you ever need to change something or edit it for something that happened, you can of course go to the closed position or overrided position. You can change the status to closed or overrided, or you can adjust the profit and closing price here just if you need to account for assignment. Again, we've got videos on that that'll help you out as you continue to go forward. The last thing here is, again, option alpha doesn't charge commissions because we're not a broker, but many traders do not pay commissions when trading with option alpha anyway, so we don't include them in the platform. But if your broker still passes through any small exchange fees or trading commissions for different products or fees that are specific to your account, then you definitely want to make sure you check with that. That won't sync up with option alpha. We don't include those because they're all so specific for different accounts and levels. Just make sure you account for that as you move forward. Number 5, the most important one, I think, besides maybe number 1, 2, 3, and 4, is stick with your strategy. Zoom out and see the bigger picture. This one could arguably be the first thing that I talk about, but I want to talk about liquidity and pricing first. But it is equally as important, is that when you start live trading, you have to zoom out and see the bigger picture. You cannot have this small focused mindset when it comes to now transitioning to live trading. I've often said that patience and persistence are critical to your ability to find success trading. And it's true, because without these, you will continue to struggle. So many people turn on a bot and after 1 or 2 trades, whether they go good or bad, they just quit and turn it off, right? Or stop with the strategy. But you can't do that. You know that. Like in your core, you know you can't do that. So you have to zoom out. You have to lean on your research and backtesting and everything that you did before you got to that point of turning on the bot live. And then you have to zoom out and see the bigger picture. The second thing is that the long night, or some people refer to this as the flatlands of a strategy, are often periods followed by eventual growth. And we don't know the path or distribution of our trades, so we need to have long-term mindsets from the beginning. So this means if you've done research and backtesting of your strategy prior to trading, then you should have confidence to stick with it, because it's mentally if it's mentally a struggle, then you need to scale back your position sizing. But if you're doing the research, you know what you have, then you should have the confidence to stick with it. Lean on that. Be reliant on that research and backtesting that you've done to know that you're sticking with the strategy long term. Don't get sucked into those long nights or flat lands, which are eventually going to happen with your trading. So what do I mean by this? So the distribution of our trades, we don't know. So here's an example that can kind of help prove the point. And I'll show you a backtested example also, so helps further prove this point and kind of drive this point home. But we did test at one point a 45-day, I think it was a 20 to 45-day position. It was targeting around a 70% win rate. And we tested this over a series of and sets of trades, over 100 trades. And what you can see here is that each of these lines is a different set of this testing sequence that we did. And all of the lines A are not the same because the distribution of trades as you start trading, as you start accumulating trades, will be very, very erratic in the first half. And then it will start to compress towards the expected outcome. And that's what we're after here, is that if you are trading and you start a bot, the bot could have a or the strategy that you're trading should have a 70% chance of success. Theoretically, if in this example, I'm not saying all the trades do. But let's say you're starting a strategy that should have a 70%-ish chance of success. Well, after a couple trades, maybe after 37, 40, 50 trades, you still find yourself at 60% win rate. That doesn't mean that anything is necessarily wrong with the strategy. It just means you haven't traded enough. If you're only making 5 or 10 trades and then closing it out, anything can happen. Literally anything could happen. You could have 100% winners. Notice that in some of our testing cases, after 7 trades, you had 100% winners. You think you found the fountain of youth for options trading, right? And on the other example, the same strategy, just in a different time, was tested and you had 50% winners. You think it's a terrible strategy. It's the worst. It doesn't work, right? So that it doesn't matter because you're not trading enough. You're not giving it enough time. You're not being patient enough to let the system continue to work out. And if you did, you can start to see that it's starting to converge the more and more you trade on the expected outcome. That's what we're after. And so actually, if you go here and you say, okay, now after 500 trades, let's expand this out even more. After 500 trades, all of the different strategies in their different times and periods of entry were all converging around the same 70% expected outcome. And so this really proves the point that you have to stick with your strategies. Do your research, do your back testing, then turn it on and stick with it. You got to zoom out and see the big picture. The other thing you can look at is something like this. So this is a back test of an iron condor. This is a strategy that I run right now live, but I noticed that inside of the back test, there are many periods that are flat periods where the strategy does not perform as expected. Because when you look at this, if you just happen to look at this chart, the first thing you saw probably visually was this up and to the right P&L diagram of the strategy itself. And that's what I saw too, right? That's what we want to generally see. But within this, because if we zoom out, we see that. But within this, if we zoom in, what we actually see is we actually see periods, some periods that are rather long, where the strategy did not do anything. We're just kind of moved sideways or maybe even moved down. Look at this period here. I mean, that's almost an entire year that the strategy moved broadly sideways. So a lot of people, they don't stick with the strategy long enough to actually get through those periods. Just recognize from the start, when you start trading, you might encounter these periods of time and you might have to sit through these and go through these periods. It doesn't mean it's not going to work. It just means that you have to be patient to let the numbers work out. Here's another example. This is the monthly iron condor bot. I've gone through this and showed this many times. I'll add links to it below this video. But this one went through a period right here, which was a long period of time where it was just moving sideways, right? And then it had to jump up, and now it might be in a period where it's just moving a little bit more sideways, and that's okay. You just stick with it, get the long-term metrics to where they need to be by increasing your trade count and sticking with your ultimate strategy. So you got to make sure, again, you stick with your strategy moving forward. That's the biggest thing that you can do, and inclusive of all the things we talked about. So I hope this was really helpful. I hope going through this, it gave you a lot of things to think about. I know I probably missed some things, so if I did and you've got some feedback for other traders or other people, if you're trading now live and you wish you could tell someone something about what they should do before they start live trading, add a comment below. We'd love to know what you think. If you thought this was helpful, also let me know in the comments. Give it an upvote, a like, a share, subscribe to get more videos from us here at Option Alpha. And until next time, happy trading.